Imagine walking into a party where everyone seems a little too cheerful, the music is just a bit too loud, and you start to wonder, how long can this good mood really last? That's kind of where we're at with today's US stock market, especially when you look at the S&P 500. The energy is high, optimism is everywhere, but there's a growing question. Are we all just a little too hopeful? Today we're diving into some eye-opening analysis from DataTrek Research, which has taken a hard look at the S&P 500's so-called fair value. The big concern? Stocks might be priced for perfection, and unless some real stars start to shine, the good times might not last. Let's break this down. The S&P 500, as you probably know, is the main stage for the 500 largest public companies in the US. It's the benchmark most investors use to gauge how the overall stock market is doing. Right now, it's been on quite a run, hitting new highs, breaking records, and making everyone with a 401k feel pretty smart. But like any party that goes on a bit too long, there are folks starting to look at the exits, or at least the clock. DataTrek's research centers on fair value, basically what the S&P 500 should be worth based on its fundamentals. And that's where things get interesting. Today's valuations are, to put it plainly, sky high. We're talking price-to-earnings ratios that are well above long-term averages. For context, the S&P 500's forward PE ratio is hovering around 21. The 25-year average? Closer to 16. That means investors are paying a premium for every dollar of future earnings, betting that those dollars will be bigger, fatter, and juicier than ever. Why such optimism? Well, a lot of it comes down to a handful of superstar companies. Think tech giants like Apple, Microsoft, Nvidia, Google, and Amazon. These Magnificent Seven, as some call them, have been doing the heavy lifting, driving much of the market's gains. In fact, these few companies now make up around 30% of the S&P 500's total value. That's a big bet on a small group. But here's the catch. If these companies stumble, or even just slow down, the whole market could feel it. DataTrek points out that for the market to keep rising from here, we need more than just the usual suspects. We need new leaders. That could be companies in healthcare, energy, financials, or even the often overlooked industrial sector. If fresh faces don't step up, the market's high valuations start to look, well, a little shaky. Let's zoom out for a moment. Historically, markets go through cycles. We've seen periods of wild optimism before. The late 1990s dot-com bubble comes to mind. Back then, everyone thought the internet would change everything overnight, and stock prices soared. But when reality failed to keep up with the hype, things came crashing down. Now, I'm not saying we're in the same place today. Many of today's tech leaders are incredibly profitable and have real, lasting businesses. But the lesson is clear. When expectations get too high, it sets the stage for disappointment. So what could keep this party going? For one, strong earnings growth. Companies will need to deliver not just on current profits, but on the rosy forecasts that are baked into their stock prices. That means innovation, cost-cutting, and, for some sectors, maybe a little bit of luck. Another factor is interest rates. If the Federal Reserve starts to cut rates, that could give stocks a boost, making future earnings more valuable in today's dollars. But so far, the Fed is being cautious, wanting to see inflation cool off a bit more. There's also the wild card of the broader economy. If we avoid a recession and keep seeing job growth and consumer spending, that could justify higher stock prices. But if there's a slowdown, suddenly those lofty valuations could turn into a liability. Remember, in markets, mood can change fast. What feels like a sure thing one month can look like a risky bet the next. Let's not forget the impact of global events either. Geopolitical tensions, supply chain disruptions, or even unexpected regulatory changes can shift investor sentiment in a hurry. It's a reminder that while the market loves a good story, reality has a way of asserting itself. So where does that leave everyday investors? DataTrek's analysis suggests that now is a time for a little extra caution. That doesn't mean you should panic or pull out of the market entirely. After all, trying to time the market perfectly is nearly impossible. But it does mean being thoughtful about your portfolio. Diversification matters more than ever. Relying too heavily on a handful of big winners can make for a bumpy ride if those stocks hit a rough patch. Consider mixing in sectors or companies that haven't already soared, or even looking at international opportunities to spread out your risk. One strategy is to focus on quality, companies with strong balance sheets, steady cash flows, and a track record of weathering storms. And don't forget about your own timeline. If you're investing for the long haul, short-term ups and downs are just part of the journey. To sum it up, we're in a market that's rewarding the most optimistic investors, but that optimism comes with risks. The next leg higher might require new leaders to step up, or a dose of reality to bring valuations back in line. Either way, staying informed and keeping a cool head will help you navigate whatever comes next. If you found this analysis helpful, don't forget to like, comment, and subscribe for more insights on the markets and what they mean for your money. And here's something to chew on. Is today's optimism a sign of true opportunity, or are we all just dancing a little too close to the edge? Only time will tell, but staying sharp and curious is always your best investment. Thanks for watching, and I'll see you in the next one.